when you look at what the market is focused on, I mean, it's still interest rates, inflation. Actually, how much longer can these interest rates stay for, you know, this high, if not higher?
Yes, absolutely. I mean, there's so many facets to this. I mean, it started, I think, with very much stronger growth in the near term, recession risks being pushed out, and obviously with stronger growth comes stronger inflation and higher rates. But I think the move that we've seen over the last couple of months is more than just the near-term recession. It's also about the structural makeup of the economy and the notion, which I think is now being endorsed by central banks as well, that actually the structure has changed. We've reached various tipping points when it comes to geopolitics, when it comes to the capex needs, that ultimately will push inflation and growth up over the longer term, and thus that move in rates has actually been more at the back end of the curve.
But Grace, I feel like this is the narrative from central banks for at least 2 or 3 quarters. It's just it takes a little bit longer for the market to catch up.
I think that's true, and I think you've also seen, on top of just the growth and inflation, i.e. the monetary policy mix within rates, you've also seen greater term premia reflective of that degree of uncertainty, and obviously increased treasury supply that we're also seeing coming through. So I think when we look at market pricing now, you know, taking the US 10-year as an example, I think markets have caught up. We feel that quite a lot is now in the price, and so, you know, prices can overshoot, but certainly relative to the fundamentals that we see, you know, 10-year treasuries look 20, 30 basis points overvalued on the short term.